Hey, Eddie, thank you so much. Busy guy right here. Second episode of Trigger Points for 2022. We're coming back every week. Next week, we got a guy that hopefully we're going to talk about it. He's coming in to talk about furnishing Airbnbs. So don't miss that one. But today we're here with Eddie Gant. He's very, very busy this week, but he said he'd take time to do a Trigger Points. We're doing it early, but he's going to give us his 2022 market update and predictions to where the market's headed right now. Thank you.
You're welcome.
Thank you.
What do you want to know?
Well, I think they want to know more than anything. Yeah. I know we always talk about it here at Jet Lending, but I think they want to know more than anything where you think, because you haven't really been in front of a lot of crowds this year.
Nope. Need more.
Yeah.
Well, I get in front of a lot of big crowds you just don't know about.
Well, we got a whole bunch of people that I know are looking forward to this. Got a lot of good feedback that they wanted to see this. So at the end of the day, where do you think we're headed? Or what do you think the current market condition is?
Well, let me, you want the short answer or long?
We need a long answer.
All right. Well, I'm gonna make a statement that I promise you in Houston area, in our investor circuit, I was the first one to say this. So I'm going to say something, and the people have heard another Houston well-known figure, maybe at least two of them actually, say it up on stage. I want everybody to know I said it at our super investor meeting, and the phrase got copied. I was the first one to say it. And that is, I don't know because my crystal ball is broke. It's in the shop. I said that at the RCC at the super investor meeting several years ago, and then I go to somebody else's major presentation, and they were in the audience, and I said, and they stole my line. And then somebody else stole my line.
There's a bunch of thieves out there.
So my crystal ball is broke, so I don't know. But as far as recent in Houston, I was the first one to say it. So we don't know. But I can speculate, and that's what I'll do.
Let's speculate a little bit.
You got to. We're going to talk two or three things here. So you got to break this down into different segments, and one is interest rates. And anytime you talk interest rates, you got to break it down into owner-occupied, homeowner, homesteaded properties, and you got to break it down into investors. And then you even have to break that down into short-term and long-term. But I don't think there's any secret out there. Somebody hasn't been living in a cave in the last 5 months, 6 months, 8 months. This year, 2022, interest rates have gone up. The long-term rates for homeowners, when I buy an investment property, you buy an investment property, we're not using those. But when we go to sell our properties, that comes into play pretty big for us. A year ago, a little over a year, we were hovering in around the 3 range, 2.8, 2.9, 3.1. I locked my own personal house in last year on a refi at 2.625.
Pretty good.
That's pretty good. That's about as low as you probably could have got. So they went up to 6, 6.1, 6.2, and they settled back in. And it's a very volatile. It changes daily. Most people don't know this, but it's based off the 10-year Treasury bill. But right now it's fluctuating 5.2 to 5.4 for several weeks. And what's happened, I think, is the general public knows that, and they go into sticker shock because everybody remembers the 3 rate, the 2.9 rate a year ago. So they freeze up, and they go like, oh, crap, let's don't do anything. We don't know what's going to happen. Freeze up. Interest rates are high. Well, heck, you go from 2014 to 2019, and the real estate market was very healthy for both sides of the game, buyers and sellers. It was a good time. It was a good time to be a real estate investor. Where were we on long-term rates? We was in the 5s. That's where we were, and everybody thought it was great because at that time everybody remembered them being in the 7s and 8s for several years. So it's all kind of relative to people's short-term memory of where we are. But that's probably the single biggest thing that slowed down the retail market. And when we talk about where we are, we got to always distinguish between the retail market, which is, you buying a house to live in over in Cypress, me buying a house to live in Tomball versus the investors that are buying it, it's really a simple business, and you simplify it. An investor only does two things with a property, and there's not a third. You either hold it or you sell it. That's the only two things you do with an investment property. Now, I don't think there's a third. I'm not aware of a third magic bucket out there that you buy an investment property, do something else with. You either hold it for long term and you rent it and take those positive things that happen to you, or you sell it. So the retail market has slowed down. Inventory is sitting around 22,000 today. That's active single family homes in the Houston MLS system, 22,000. It's up. We got as low as 10,000 and change. I never saw it go 99. Yeah. It may have gotten there for an hour or two and I missed it. But we're up to 22,000, but that's not a bad number. That's still
2.5.
Yeah, I was going to say 2.4. Yeah, 2.5 months of inventory. You're right. And that's not unhealthy. Not unhealthy, but everybody remembers it was 1.1 at the end of the year.
Yeah.
It's that trend that's a little bit scary, and you can't ignore it. The impact that does on a real estate investor is, if you're planning to buy it and sell it for profit, you plan to buy it, fix it up, and sell it for profit. And there's only three people you sell a house to. People don't realize that. There's only three people: an owner occupant going to live there, an investor that's going to hold it, or an investor that's going to flip it again for profit. That's the only three people you sell a house to. You make the most money historically selling to the end user on a single family house because they'll pay you more. So what you have to do as a real estate investor in 2022, if you're buying houses today, you shouldn't be basing your ARV resale off the peak from 2021, because that's not there today. It's not far from it, but it's not there today. But the bigger deal is where we used to sell them, and if you put a house on MLS, you were closing and getting your money in a month later.
Mm-hmm.
That's not going to happen today, most likely. Okay, you're going to hold it longer. So what that means is the investor must build into carrying cost, or another term for it is holding cost, for your payments. You have to build in more money for that. Budgetary. You have to budget more money for that, because you're going to hold it longer, which means if you're operating on a limited amount of funds in your bank account to carry houses where you try to flip them, you need to be very careful with that. You can run out of money. You've heard me say on stage for years that the only way you go out of business in real estate investing is you run out of cash.
Absolutely.
Anyway, I rambled for a long time there. You want to pinpoint some of that back at me, because I kind of talked and you didn't get a chance to answer. That's kind of typical. That's kind of typical being around me, isn't it?
It is. So let's talk a little bit about how actives are at 22,000 right now. As you said, they were low. We had an increase. Somebody said the other day, we're in a buyer's market. Would you agree or disagree with that statement?
I would disagree.
Okay.
Now, I will tell you this. Having said that, I don't want to contradict myself, but you're in a better buyer's market today than you were a year ago.
Truth.
I mean,
more inventory.
I probably talk to as many investors week to week than probably just about anybody. I mean, I talk to a lot of investors daily, and as you do too. Most of them tell me that their deals that they're getting today, their lead flow that they're getting today, has drastically improved over the last few months. Okay,
I can see that.
Yeah. I mean, I even made the comment as we looked at our jet lending files this morning. People that are bringing us deals to fund for them. I was looking at numbers on numerous files. I probably looked at a dozen this morning, and I think I made the comments on the file. This is a good deal. I would buy that deal. our clients getting a great deal here. I made that same variation comment repeatedly. So there's no doubt about it. I wouldn't call it a buyer's market. You can't call it that at 2.4 months of inventory. I'll tell you one thing I severely just big time disagree with, and I don't know why they say this other than they're just repeating what they've been told for years. But you read so many articles. I read one yesterday that they said 6 months of inventory is equilibrium in between buyer's market and seller's market. Bull.
Okay.
6 months of inventory is a buyer's market. It's get away from this 6 months is equilibrium. It's not.
I think I've heard
That's
you say,
too big of inventory.
I think I've heard you say somewhere between 3 and 4 months is when it starts to shift.
If I had to throw a dart, I'd say 4 months is equilibrium.
Okay.
If I had to
Anything
say,
past that is starting to shift.
it's a buyer's market after you go north of 4 months. And I get sick and tired of reading these articles. It's 6 months. They're just repeating somebody else because it makes no sense today. It really don't. But a lot of people, you look back to where we were in Houston, single family actives, and I know the number because it's written on my wall because I knew it was a big day in our industry. COVID Monday, which was, I believe, March the 9th, 2020. And I call it COVID Monday because Tuesday the 10th, when they canceled the Houston Rodeo, college baseball, college basketball tournament, the NBA shut it down. Everybody started to shut it down. It was 18,044 houses on the market that day when I wrote it down. 18,044. And then we went down to 10,000 twice. Went down to 10, back up to 12, down to 10. Can you tell I'm kind of obsessed with that number?
Oh, you are.
It's the number one sign you got in the industry where we are.
Mm-hmm.
So we went 18 to 10 to 12 to 10, and then we went back up, and we held for a long time at that 12, 13,000 number, and then it shot up to 20 in a hurry a few months ago. Boom. I mean, that curve went just like that. Then it got to 22,000 about, I'm going to guess 3 weeks ago, 4 weeks ago, 4 weeks ago.
It's kind of leveled off.
It's leveled off.
Yeah.
I mean, yesterday was at one time when it went down to 21,900 something, and then later it went back up to 22,000 and change. But that's a big deal now. I mean, you have to watch that. But back to your question, we're still in a seller's market to a certain extent. But I think it's these interest rates and these people, they froze up. They don't want to do anything. They're scared. The other part of this is they can't turn on the dadgum news. And you guys listen to, you can't believe that crap out there.
Yeah.
I'm not going to turn this into a political conversation, but you can't believe 90% of the crap you hear. And you can't walk down the street or turn on the news by hearing the R words.
Yeah.
Recession.
Yeah. It's out there. It's everywhere. So my next question, and this is a very loaded question. Should people be scared to invest in real estate right now?
Absolutely not.
Okay.
And I know we provide loans. What the hell should you say? But no, come on. I mean, first of all, you should be buying at a discount. A discount is a discount is a discount. Okay, let's just say the market turns south on us like it did in 08, 9, and 10. And it's not going to, I don't think. But Houston was a little bit transparent to that. We had a dip in values in some areas. We had no dip in value in other areas. But the areas in Houston, Texas, and I don't know how broad our audience is, I'd say in Texas in general, the worst case, you had a 10%, dip in value. Well, you ought not be buying them at 10% discount anyway. You need to be buying them at 30 to 40% discount. Why? Because you have to if you're going to flip it, and B, because you can. So okay, you buy a house for a 35% discount and the market dips 10%. Okay, big freaking deal. Or you just made a little less when you sold it, or you made a little less down the road when you held it and then sold it.
Okay,
that makes sense.
That does make sense. Okay, there's a lot of buzz out there that said the world's going to come to an end on the financial crisis is going to happen after the midterms. Thoughts on that?
Well, I'm glad you brought that up. And again, I'm not going to turn it to a political conversation too much. You have to look a little bit. I think the elections is one of our keys to what happens. And I think the 2024 is bigger than the midterms coming up here this year. There's just no way around it. No matter which side of the fence you're on, it's going to impact which way these elections go. If you wanted to turn it to a political conversation, we'll offend half the people out there.
Let's not do that.
But it's going to impact you. And that's another reason. Remember, I did this. People freeze up over the interest rates. They're freezing up because of interest rates. Shock, not because it's 5.3% today. They froze up because it went up,
and it was a shock.
That's a shock
to the system.
Okay, and you can't turn on the news about the R word, so people freeze up. Oh hell, what's going to happen? And the same thing with elections.
Buyer's confidence.
Oh crap! What are we going to? No matter which one wins, things will go back to semi-normal after the election because that unknown is removed.
Yes.
Regardless of which side wins, the unknown is absolutely
true. The funny thing about elections is everybody thinks the worst is going to happen if red or blue wins, but at the end of the day, when you wake up tomorrow morning, you're still breathing, you still got air in your lungs. Guess what? You can still go out there and buy investment properties.
New legislation doesn't mean you don't continue as a real estate investor and buy investment property. It governs your strategy on.
Talk a little bit about that. If dive a little bit deeper. Like let's say we're in a slow market. What is your strategy versus a hyper market?
If you're in a slow market, meaning it's easy to buy them and difficult to sell, I think is what you mean. Like it was in 08, 9, and 10. And then again, I don't think we're going to go to those extremes. To let people know. And I set it up on the stage. I did a little research. So I did the Think Realty presentation earlier this year in July 2010. There was 56,000 houses on the market. Mm-hmm. That was the peak of the 08, 9, and 10, 11 was July 2010, 56,000 houses on the market. Okay. Remember I said with 22,000 today.
Yeah, that's a lot.
The buy and hold is better because more people are trying to rent and there's more renters. Okay. So buy and hold. Alternate sales strategies are fantastic. And it's a difficult thing to learn how to do it right. It's not difficult to learn how to do it. It's difficult to learn how to do it right. And owner finance becomes a very, very, very viable and good strategy for selling houses. But I used to teach an owner finance class, and other people teach them, and they'll teach it for an hour or two. Hell, it's all day just to teach a class on it. There's that many variables. Some people, I remember, and some people still today teach a 2-hour class on owner finance, and they market it as you come out of there knowing everything. Hell, we spend 2 hours on insurance. How to get them properly insured. Okay, so other alternate strategies. In Maine, I'm gonna say owner finance, but you have to be more creative. Okay, you can't be a one-trick pony and sell your properties if you buy in volume. Okay, you need to learn how to sell them as is to investors. You need to know how to sell them as is to a owner-occupant homestead type buyer. You need to know how to do minor improvements and do both of those. You need to know how to fully rehab if you have to. You need to know how to get them rent ready and rent them and get your funds available to hold those rental properties. Same thing on owner finance. It just, you got to be more versatile in your sales because you're not going to be, you can't just sweep the floor and throw them on MLS like we've been doing for the last 4 years and they sell in 2 weeks. Doesn't happen anymore.
No.
It doesn't happen.
It doesn't.
Okay. But you should be buying them deeper.
And so just to give y'all kind of a heads up. So Eddie sees and forecasts stuff a lot earlier than most people do. I'm sorry. It's proper English. He told us back in June, start educating your investors, start letting them know hey, this is where we're seeing things go. This is what you need to do. And I have been talking to guys ever since June. Hey, look, you're fixing to have more opportunities to buy houses. You're fixing to have a higher inventory. You need to wait and not pay these higher prices, because at the end of the day, you're gonna, once you have more inventory, you're able to go out there and make better offers.
Here's an adjustment that every investor needs to know about. Let's say you buy a house with the intent to flip it. To maybe you're gonna buy, fix it, and sell it quick for profit. A flip, okay? And you do a good job on your remodeling, and you put it on MLS. 60 days later, 80 days later, 90 days later, that house hadn't moved. Okay, you got to make a decision, because you can't. It hadn't moved in 90 days. What makes things going to sell tomorrow? Unless you do some things. One would be the obvious: lower the price, because the market has rejected that property at that price for the last 90 days. So lowering the price may help. Depends on how much you lower it. But you got to look and see what your competition is doing. What are you competing with today? I mean, it may be 3 houses within a half mile. It may be 33 houses within a half a mile. And then another key thing that people don't do in this business, because they just don't know to do it. They hadn't had proper education. But if I put a house on the market, what's the day? August the 30th?
The 30th.
Let's say I put a house on the market July 1. I've done a great job on the remodel, and it's pretty. It looks good. And I put it on the market at $299 on July the 1. Okay. I'm sitting here 60 days later with no sales, no offers. What people won't do than I do. I go back to July 1 within a half a mile or the subdivision, and maybe up to a mile. And I look at every house that went pending in the last 60 days. And then I look at every one of them and I ask myself the question: why did they offer on that house and contract and not mine? And you got to answer that question on every one. I say you look, and let's say 9 of them went pending in the last 60 days within a mile. I'm going to look at every one of them.
You look at the solds too, or no?
I'm looking at the ones that went pending since mine went out, because I'm going to make the assumption if it's within a mile and within a reasonable value compared to mine. Say I'm on the market $299. I look at everything from $200 to $400 probably. I mean, if it was an $800,000 house went pending, well, I wouldn't compete with that house. There's just no need to look at it. Look at every house. Why did that buyer buy that one and not mine? And you answer the question to yourself honestly. Why? Let's say you look at the same square footage and just as pretty as mine, but it was listed $269. Well, that answers your question right there. If it was mine's $299 and that one was $320, and they picked it, was it that much prettier than mine? Was it have an extra bedroom, extra big lot? Why did they buy that house? And you have to answer those questions, and then you make adjustments based on that. But you get to a point, maybe you can't sell it, or it don't sell, or you can only sell it for less than you got in it. Then the number one solution vastly is rent it. Okay, get out of your short-term money, get into long-term money, and rent it. And you will rent your way out of it. It's the only way to recover from a bad buy other than owner finance. If you're too much into it and you can't get all your money back from a sale, and you just refuse to take a loss, you have 2 options: rent it or owner finance it. And don't know really of a third one. Okay. And you rent your way out of it, or note your way out of it. Did that answer
that definitely answers the question? So if you got a property that's not selling, put a renter in there and get yourself out of trouble until the market gets hot again.
Yeah. I use the analogy. Let's just say you were $100 negative a month on your cash flow because you had to rent it and you couldn't sell it. Well, maybe not all of us, but most of us can survive $100 negative for a year.
Yeah.
But let's say you didn't rent it and your payment to your lender and your taxes and insurance is $1,500, and didn't rent it, did not. Then you're negative 1,500 instead of 100. I don't care who you are. If you got a bunch of those, you're going to eventually run out of money, and you'll be out of the business. So if you can absorb that $100 a month for a year, 2 years, then that's what you do. And in 08, 9, and 10, that's what we did with a lot of houses. We just couldn't. You don't want us to try to sustain that 1,000 to 2,000 negative a month. Cut it down to $50 a month, $100 a month. And a lot of investors refuse to do that, and eventually it drains their cash, drains their liquidity, and they're sitting there with inventory, with equity, but they can't they can't maneuver. They can't do deals anymore. If that makes sense.
It does. All right, so big question. You don't think that we're about to have a crash, correct? Because
I don't think so, but like I said, my crystal ball's broke. I'm supposed to be out of the shop in a week or so.
Well, let's hurry up and get that crystal ball back in here so we can figure this out.
I don't think so, but you never know. You never know.
Yeah,
could happen.
Could. What do you think the difference between 2008 and now is?
It's simple. 2008 was all about the the collapse of the subprime industry.
Yes.
Lending.
Do you think that there's a subprime industry out there right now?
There is, but it's always been. But here's the difference. The subprime industry today, it's not called subprime, but that's what it is mainly the lending for investors. Okay. And here's the difference. In 2008 and prior to 2008, we were closing loans. I say we, the industry was closing loans to people with no documented income at no money out of pocket. There was a huge, all the subprime lenders had this product, 580 minimum credit score and 100% loan. 580, 100% loan. So these people were getting in these loans for zero out of pocket, and they were all on 2-year AMs. It was fixed for 2 years. It's called a 2-year AM. Fixed for 2 years, and then it went adjustable. And these rates were high. Even the adjustable rate even the fixed rate you started with was high. And then when adjustable, it really went high. So you had all these people that didn't have a history of paying their bills anyway, buying houses with zero out of pocket, and that's what happened. And if you had a 560 credit score, you could get in them for 5% down. If you had a 540 credit score, you could get them for 10% down. So you had a history of and you could roll all your closing costs in. So the 10% down wasn't 90% loan to value. It was higher than that because you was able to roll your closing costs in. So you had all these people that did not have a history of paying their bills, buying houses, no money out of pocket, and it just collapsed on them. And then as you can expect, everybody overreacts. But it never was in 08, 9, and 10 an investor loan problem. It was owner-occupied loan problems. All right, today, the same bucket of money, which is Wall Street, still funnels, all of these, we call them non-QM or DSCR loans. It's not called subprime, but it's coming from the same place. What's different? These are cash. These are revenue generating properties. Okay, not someone just living there, and it's a minimum of 680 credit score for the most part. So it's people that have a history of paying their bill, and the loan to value is 70 to 80. That's the big difference. But make no mistake about it, it's the same source of money,
but they're just doing it smarter.
Well, again, these are not owner occupied. These are revenue generating properties, investor rent houses, and the loan to value is 70 to 80%. So it's totally different, but it's the same supply of money, which is Wall Street. There's this famous book, and I'm not a book reader. I don't sit still long enough. I'm not either. I do Automobile University though, and there's this famous book out there called "Whose Fault Was It?" And so you can ask almost everybody on the street the collapse of the subprime lending in 08, 9, and 10, whose fault was it? And most people tell you it was the lenders. The lenders were only underwriting the files per the guidelines given to them by Wall Street. Wall Street said, Mr. Lender, if you'll originate me a loan with this underwriting criteria, make them have a 580 credit score, put them on a variable loan, and this is the pricing, and we'll do them 100% loan. Lenders didn't set that. The lenders closed loans to that criteria that was from Wall Street.
So with the DSCR loans, I mean, we write quite a few of those here in house with Wall Street's money.
It's Wall Street money.
I would say, and this is my opinion versus them versus now, it's a lot more protected because at the end of the day, if investor stops making their payments, Wall Street can take that loan over and still have a renter in place.
That's right.
And they have equity already built in.
Yeah, that's right. And you're dealing with a borrower that's got a 680 credit score. It means he or she has a history of paying their bills. Okay, that's what credit's all about. Does the person pay the bills or not?
Yeah.
No, the FICO scoring system is a numerical number assigned to someone based on their history of paying their bills.
Mm-hmm.
Basically, if you're low score, it means you have a history of not paying your bills. If you have a high score, you have a history of paying your bills, and that's what it's all about. Probability whether you're going to pay this payment or not. That's what when you want to simplify. But we call them DSCR loans. We used to call them non-QM loans. That term is kind of going away. As we go to the national events, you don't hear the word non-QM anymore.
It's all DSCR.
It's DSCR. Debt service coverage ratio loan is what that stands for, if you don't know. As we said multiple times here, it's a Wall Street product, and that product did not exist. I don't know the exact, I'm going to say 4 years, 5 years ago, probably 4 years ago, that product didn't even exist. And here we are, and we're closing a ton of them, and it's for investors that don't want to show or can't show their income, but they have good credit and they got a rent house at 75-80% loan to value, and they need a 30-year fixed loan on it. What do you close them at these days? What's your rate?
Sevens. Yeah, sixes, high sixes, sevens.
Yeah, and last year we were closing them 2 points under that probably. And Wall Street's very volatile. You're talking about the consumer doing this and get a
Wall Street does the same thing.
Wall Street's worse. So anyway, what else, sir?
Well, I guess we've covered predictions, or did we cover? We did cover some predictions.
Well, we don't know. I don't think we're going to have huge changes. I think eventually rates are going to get just a little bit better than they are. This is interesting. When I prepared for that Think Realty presentation, which I think I did in March, I did a lot of research for that presentation. I went back and I looked at major organizations, major economists that were on record in the fourth quarter of 2021 and giving their predictions for 2022. And by the time I gave the Think Realty presentation, all of them was in the process of revising their predictions for 2022, and they were totally different
compared to what
March, April 2022 as to what they predicted during the fourth quarter of 2021 for the next year being 2022. They all were wrong. They were all way off. Wrong is not a good word. They were all way off. And then their revised predictions, they were way off from just the fourth quarter. So predictions are, what they are. They're predictions. We don't know. I would anticipate we're going to have a little more of the same of what we got now. I don't think it's going to go too harsh one way or the other. And again, I think the elections is probably as much in the whole history of the United States is probably as important as ever.
Okay.
With the way it goes.
I have to ask this question because I don't think I've ever asked you in an open forum or at all. There's a lot of pit noise out there about the whole world's economy changing to a different type of monetary system. Mm-hmm. What are your thoughts on that?
You talk about the Bitcoin and all
I can't exactly pinpoint what they're thinking, but they're saying that we're fixing to see a huge shift in the way that we do business on the web.
Yeah.
Two,
Well,
our financial system is going to be totally different.
I'm probably not going to answer the question.
Okay.
But it's probably with what I'm going to say. But here's what I'll tell you. I remember sitting at this table last year and us talking about, oh my, what changes are we going through? I've never seen it change like this before. In 2020, during COVID, we sit right here at this table and we talk, oh my, look at all the, I've never seen it change so much. I can remember being on stage in 2019 before we ever knew about COVID, talking about what a change in our industry due to what all technology is bringing us. I can remember the years before that talking about, have you ever seen such changing times? 2008, 9, 10, all we talked about was how it changed from 2007. Here we are in 2022. We're going to be talking next year about all the changes. What all those changes are, I don't know. But I know we're going to be sitting here talking about, oh my, all the deadgum changes that we had since last year. So it's going to happen. I just don't know. And I don't think anybody does. You're talking about changing currency and such. Maybe it was big news yesterday. But yesterday, I was trying to buy 2 houses and sell one. I was trying to manage repairs on 3 or 4 rent houses. I was working on MLS to, try to get a house sold last night. I was working with my property manager on some evictions. I was working on my task at hand yesterday. So I take care of Eddie's world rather than worrying about all this other stuff, to be honest with you. And I would advise everybody listening to this probably do the same thing.
Just
I take care of my world every day.
Worry about what you can and forget about the noise.
I don't pay any. What's going to happen is going to happen. As things change, I am on top of it to make adjustments in my business. I think I'm usually ahead of the curve. I think I'm more ahead of the curve than most investors because I'm scarred up. I got battle scars from changes, and maybe I didn't change quick enough. But I watch it pretty close of the changes coming. I don't worry about the world currency changing. I can't control that. I can control whether or not my tenant pays me on time, and if I file my 3-day notice to vacate, and if I can make an offer of. Yesterday, I made an offer of $310 on a house that I had an ARV of $430 on, and I got a verbal on it yesterday, so I can control that.
Okay,
that makes sense.
That does. Control what you
can
control what is in your bubble, and forget about the noise outside.
Look for help if you get confused. Listen to things like this. There's other knowledgeable people out there. They can probably also. I don't know of anybody more. I'm sure there is. I just don't know them. They're more knowledgeable than me and you. I don't know. I'm assuming there's somebody out there. I don't know.
I don't know them either.
I don't know them either. Hey, I had a college professor serve my surveying class. This maybe somebody find this humorous. First day of surveying class at Mississippi State. I walk in, sit down, and the teacher comes in, and he had a reputation being a hard ass. We'd all heard from the upperclassmen. I think you take surveying your sophomore year in civil engineering. But he walked in, he slammed his book down on the desk and said, I don't know the most about surveying, but I know the most about surveying anybody around here. That kind of reminded me of that. So that was a joke, y'all. I mean, yeah, we probably got a little knowledge, but there's probably people, but I just don't know them.
I just don't know them yet. So I'm gonna tell the audience something. If y'all don't already know this, social media and TikTok and all these things that you can go on and scroll all day, they are designed to algorithm based upon the stuff that you're watching. Chris Bounds has got some good stuff out there. We've got some good stuff out there. Pay attention to the good stuff more than you pay attention to the bad, because those bad algorithms can get there, and it's designed to make you anxious. It's designed to turn your head into the negative. What I'm going to say is stay positive. The world hasn't come to an end. I don't think it's going to come to an end in the near future. Eddie's just said that. What you got?
Well, I'm not through. Let's talk about something.
Oh, okay.
That's about what's going to happen. There's other factors here. We talked about interest rate coming inventory. Population growth.
Oh yeah, there's still a housing shortage. There's still a huge
supply and demand situation that we were in for a few years has not been solved. It's been put on a little bit on hold due to people doing this freeze up. It's still there. If people don't know this, they should. If you're in Texas, that we're now 30 million people in Texas. That, depending on which article you read, it varies from 1.2% to 2% growth per year in Texas. If you're not very good at math, I can tell you real quick, 2% of 30 million is 600,000. Okay. That's 600,000 new people moving to Texas this year. And that's if you take the upper limit of the 1.2 to 2%, that all the articles, they're all in that range. 600,000 people, got to have housing. Some people will live in rentals, some people will buy, but it don't matter. That's a housing unit that's going to get ate up. Okay. So that is a big deal here. Okay. And that is supplied by lots of things. I think the economic cost to be here, the job that's being created to be here, and the overall climate, the overall, just affordability factors all into it. Some people move for political reasons. They'd rather be in Texas than in a different state. Okay.
Tax reasons.
Yep. A lot of things. So that's one of the reasons I said earlier we're a little bit insulated, from, when in 08, 9, and 10, California, Arizona, Florida, Michigan, Louisiana, Georgia, just to name 5 quick states, suffered greatly. Okay. Texas was not even close to the type of housing downfall that they had in those states. And it's because we're insulated by the economy and the jobs and people coming here. So when you have times that change, the decision is not to get out of real estate investing or not. The change is your strategy within that. And just a real quick one, if it turns into a huge buyer's market, keep buying, buy them lower, hold them, get your finances in order, and your financing options up and running to be able to hold them. So it's just a matter of strategy of what you do.
So in a changing market, you've got to sit back, analyze what the market's doing, and make adjustments to ensure that you're keeping up with that changing market.
I'm glad I'm in Texas doing this. I wouldn't want to be in a lot of other states and do this. I wouldn't want to be, if I had my preference, Houston, Dallas, Austin, San Antonio, Corpus, Beaumont, I pick Houston. One of the reasons I pick Houston?
Why?
You live here?
What's that?
You live here?
Do I live here? Yeah, that's one reason. I don't have to move. This is I've said it. I don't know if people believe me, but our industry is very close here. I can pick up that phone right there and I can call 100 people today and get some advice.
That's true.
The industry is tight here.
That's true.
That don't mean everybody helps everybody, but generally speaking, the industry is close as compared to other cities where they're not as close. The industry is not as close.
I would totally agree with that statement. I mean, up in Dallas, Fort Worth, and other areas that I've been or talked to people, they're not as apt to pick up the phone and call their competitors and ask them.
That's right.
I mean, I know y'all have got a relationship with some of the more seasoned hard money lenders.
Yeah, I went to dinner 2 weeks ago. What I would call a couple of the leaders in the industry. I don't think you get a whole lot of that in other places. Certainly on steroids here. The industry is close.
True. That's true.
Here. But it's a great place to be, in my opinion, for real estate investing. And that doesn't mean, I buy in Austin, actually the deal I made an offer on, I made an offer of 310, got a verbal yesterday on a 430 house. It's Austin.
Chris, Lacey Walton just said, Eddie, you're like a crystal ball. It's Lacey going to be as intelligent Is Lacey going to be as intelligent?
She's talking about my head, the shape of my head.
No, she said you're like a crystal ball. Is Lacey going to be as intelligent as you are now in real estate investing?
I hope so.
Yeah, me too.
Hope you set your sights just a little bit higher though.
I mean, at the end of the day, that's kind of why we do these things.
Yeah.
Is we have a weekly show. We try to educate people a little bit so that they don't feel like that they're out there alone in this real estate investing world.
It's tough being alone. If you think you are, and you're really not. I remember my first house, June of '99. I'm 23 years, and over 23 years now. June of '99. I remember this. It was in on a street called Smiling Woods. It's right over here at 249 and Beltway 8. Okay, Willowwood is a subdivision. Bought my first house, and I remember getting it signed. Again, I've never done it before. I get the contract signed. I go back to my pickup. I sit down. I crank it up. I probably turn the classic rock on or something. I put the AC on, and I went, yes. And my next thought was,
what do I do now?
What do I do now? That was my thought. I did not know the next step. Figured it out, but I didn't know I had to get that contract to the title company. And I certainly didn't have a title company to take it to. I didn't know a title company. I didn't know exactly where I was going to pay for it from. I just know I just bought that house at a discount. Remember today, made $19,000 on it. And that was June of '99. I thought I had hit the grand slam of grand slams.
I wasn't even thinking in June of '99 anything about real estate. I can promise you that. I was in Germany in June of '99. So
was you flipping houses in Germany?
No, I wasn't flipping no houses in Germany. I can tell you that.
You toting a gun?
I was toting a gun and doing all kinds of fun stuff in Germany, freezing my butt off.
Did you have M16s in?
We did.
You toting an M16?
Yeah. So
I was toting an M16 too when I bought that house. All right. I hope we help somebody today.
I do too. And that's what this is all about, is trying to help people figure out what's going on, how they can improve their business. And at the end of the day, we appreciate you coming in. I know it's a short week for you. Where are you headed this week?
What's that?
Where are you headed this week?
Mississippi.
Oh, he's going to Mississippi. All right. Well, I know you got a busy
That
schedule.
still talk Southern enough?
No, you did. You did.
Okay. Because I do talk Southern. I'm okay with that. And the more beer I drink, the worse it gets.
So, what's hunting season going to look like this year?
I hope it's cold and wet. Last year was hot and dry.
But we did have that one good day.
Yeah. It's not fun to hunt when it's hot.
No, it's not.
Too many mosquitoes in those woods for me.
But we did have that one cold day.
Have fun.
Yeah. Anyways, guys, again, next week we're going to have, I can't think of his name off the top of my head, but he is a furniture company that rents furniture out to Airbnbs. Going to want to pay attention to that. He's going to give you ways to grow your business. I'm sorry, short-term rentals. We don't say Airbnbs. Airbnb is an app.
I'm on a mission to save the world.
Yes.
Quit calling a short-term rental a VRBO or an Airbnb. Airbnb and VRBO are booking agencies.
Yes, it is a short-term rental.
Short-term rental.
Short-term rental. Yes, I call it.
And I just can't stand it to hear somebody call it an Airbnb. That is a booking agent, and not even the biggest one.
No, it's not. No.
Very few people know who the number one booking company is.
VRBO.
Nope.
It's not?
Huh? It's first place, you'll never name it, and there's not even a close second.
Okay. I wouldn't know that.
You want me to share it?
Yes.
With you? Or do you want anybody to guess until next week?
No.
He knows it because he heard me say it. Booking.com.
Is it really?
And there's not even a close second. They're so much bigger than everybody else. You know why?
I have no idea on this one.
They're big overseas.
Oh, wow. Okay.
They control the world. They may not be the biggest for Galveston, Texas, but they're the biggest in the world.
Interesting. Well, I appreciate you coming on. I appreciate you the short time spent and letting me know last week if you come on, and I know you got a bunch of stuff for a short week to get done, but the audience out there, I know they appreciate these little tidbits and the fact that you have told them, hey, get out there and invest.
You know, that's the reason I do it after 23 years.
Yeah. There's nothing to be scared of.
No.
Nothing. So thanks again. That's all our time for today. We're out here. We will see y'all next week at the regular time. Thank y'all.
Bye-bye.